put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The $185 billion lie. In the fall of 2008, while Lehman Brothers collapsed and sent shockwaves through the global financial system, another giant was quietly dying in the shadows. Its name was American International Group, AIG. For decades, it had been the largest insurance company on Earth, protecting everything from commercial airlines to oil tankers, from corporate executives to entire nations. But behind the polished marble lobbies and the reassuring promises of security, AIG had built something else entirely. A vast, intricate web of financial deception, so dangerous that when it finally unraveled, it threatened to bring down the entire global economy. The United States government, faced with a choice between chaos and compromise, handed AIG the largest corporate bailout in American history, $185 billion. But here's the question that still haunts the corridors of power. How did an insurance company, a business built on calculating risk and avoiding danger, become the most reckless gambler in financial history? And more chilling still, what if they knew exactly what they were doing all along? The story of AIG begins not with numbers on a balance sheet, but with a man who understood that the real business of insurance wasn't protection, it was perception. Maurice Hank Greenberg took control of AIG in 1968, and over the next 4 decades, he transformed it from a mid-sized insurer into a financial colossus spanning 130 countries. Greenberg was a former military intelligence officer who ran AIG like a classified operation. Executives were discouraged from putting anything sensitive in writing. Board meetings were tightly controlled. The company's sprawling international structure was so complex that even regulators struggled to map its full extent. This wasn't an accident. Greenberg had learned a fundamental truth about power. Opacity is protection. The less people understood about how AIG actually worked, the more invincible it appeared. By the early 2000s, AIG had become synonymous with stability itself. It held a perfect AAA credit rating, the highest possible grade, shared only with the United States government. Pension funds, sovereign wealth managers, and institutional investors around the world trusted AIG with their most critical exposures. The company's stock price climbed steadily upward. Revenue exceeded $100 billion annually. Greenberg's personal fortune swelled past the $100 million mark. From the outside, AIG looked like the perfect machine, a monument to disciplined risk management and corporate excellence. But inside the empire, something darker was taking shape. In a quiet office tower in London, far from AIG's New York headquarters, a small unit called AIG Financial Products had begun operating in the shadows of the insurance giant's sprawling operations. AIGFP, as it was known internally, didn't sell traditional insurance. It dealt in derivatives, complex financial instruments that most people couldn't understand, and many regulators didn't even know existed. The unit was run by Joseph Cassano, a former Drexel Burnham Lambert trader who had a reputation for aggression and an almost religious belief in his own mathematical models. Cassano had discovered a product that seemed almost magical: credit default swaps. In simple terms, a credit default swap was insurance against debt going bad. If a corporation or a bundle of mortgages defaulted, AIG would pay out. If nothing went wrong, AIG collected pure profit with no claims to pay. It was, Cassano believed, free money. The beauty of credit default swaps, from AIGFP's perspective, was that they lived in a regulatory twilight zone. Because they were classified as derivatives rather than insurance, they escaped the reserve requirements and oversight that governed traditional insurance products. AIG didn't have to set aside capital to cover potential losses. It didn't have to register with insurance commissioners. The swaps existed in the shadows, off the balance sheet, invisible to almost everyone, except the traders who wrote them and the investors who bought them. Between 2000 and 2005, AIGFP wrote credit default swaps on more than $500 billion worth of assets. The premiums poured in like a river of gold. Cassano's unit generated billions in revenue. His personal compensation climbed into the tens of millions annually. And AIG's leadership, intoxicated by the profits, asked very few questions about what would happen if those assets ever actually defaulted. But beneath the surface, cracks were beginning to show in Greenberg's empire. In 2005, after years of mounting regulatory scrutiny, Greenberg was forced out of AIG amid allegations of accounting fraud and bid-rigging schemes. The company eventually paid $1.6 billion to settle charges that it had manipulated its financial statements to hide losses and inflate reserves. Greenberg's departure should have been a moment of reckoning, a chance to examine the dark machinery he had built and dismantle the most dangerous parts. Instead, his successor, Martin Sullivan, doubled down on the strategy that had made AIG so profitable, selling protection against risks the company didn't fully understand. By 2006, the American housing market had become a frenzy of speculation and delusion. Mortgage lenders were handing out loans to borrowers with no income verification, no down payments, and no realistic chance of repayment. Wall Street banks were bundling these toxic mortgages into complex securities called collateralized debt obligations, CDOS. Rating agencies, paid by the banks creating the securities, stamped them with AAA ratings despite their underlying rot. And AIGFP, operating from its London office with minimal oversight, was selling credit default swaps on hundreds of billions of dollars worth of these mortgage securities. Cassano assured anyone who asked that the risk was minimal. His models, he claimed, showed that the swaps would never pay out. Housing prices, the models assumed, would never decline nationwide. It was a bet on certainty, and it was catastrophically wrong. Here's where the story takes its first dark turn into territory that still sends chills through those who witnessed it. Because AIG wasn't just writing credit default swaps on mortgage securities, it was also writing them on securities that had been specifically designed to fail. Some of Wall Street's most sophisticated traders had figured out that the housing market was a bubble about to burst. Hedge funds like John Paulson's firm were actively seeking ways to bet against the mortgage market. But you can't just bet against something. You need someone to take the other side of the trade. That someone was AIG. Goldman Sachs and other investment banks created synthetic CDOs, essentially bundles of bets on mortgage securities rather than actual mortgages, and found investors who wanted to short them. AIG sold the credit default swaps that made those bets possible. The company was, unknowingly, financing its own destruction. By early 2007, AIGFP had exposure to more than $78 billion in mortgage-related securities, and the housing market had begun its collapse. The first tremors hit in the summer of 2007, when two Bear Stearns hedge funds that had invested heavily in mortgage securities imploded. By fall, major banks were announcing billions in write-downs on mortgage-related assets. The assets that AIG had insured, the assets Cassano had promised would never default, were plummeting in value. Under the terms of the credit default swaps, AIG's counterparties could demand collateral if the value of the underlying securities declined. And that's exactly what started happening. Goldman Sachs came calling first, demanding billions in collateral payments. Then came Société Générale, Deutsche Bank, Merrill Lynch. A cascade of the world's largest financial institutions, all demanding money from AIG to cover losses that weren't even final yet. The insurance giant that had promised stability was bleeding cash at a terrifying rate. Inside AIG's headquarters, panic set in. Executives who had spent years collecting massive bonuses while ignoring the warnings from their own risk managers were suddenly confronted with a nightmare scenario. The credit default swaps that Cassano had sold existed across dozens of subsidiaries and hundreds of counterparties. They were interconnected with virtually every major financial institution in the world. If AIG couldn't meet its collateral calls, the entire global financial system could seize up. Banks that had bought protection from AIG would suddenly find themselves exposed to billions in losses they thought they had hedged. Those losses would force them to sell assets, which would drive prices down further, which would trigger more collateral calls. A death spiral that could drag down the entire economy. AIG had become what regulators call too big to fail. But the more accurate term is too interconnected to fail. The company had woven itself so deeply into the fabric of global finance that its collapse would tear holes in every market on Earth. By the spring of 2008, AIG's crisis was accelerating beyond anyone's control. The company reported the largest quarterly loss in corporate history, $61.7 billion. Its stock price, which had traded above $70 per share just months earlier, plunged below $10. Martin Sullivan, the CEO who had presided over the disaster, was pushed out. His replacement, Robert Willemstad, a former Citigroup executive, walked into a burning building with no water and no exit. Willemstad tried desperately to raise capital, seeking investments from sovereign wealth funds and private equity firms. But no one wanted to touch AIG. The company's problems were too large, too complex, too toxic. Every potential investor who looked at the books came to the same conclusion: this thing is going to die. Then came September 15th, 2008, the day Lehman Brothers filed for bankruptcy. The decision by Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke to let Lehman fail sent shockwaves through global markets. Credit markets froze, stock markets plummeted, and AIG, already on life support, began its final death spiral. The company's credit rating was downgraded, which triggered clauses in the credit default swaps requiring AIG to post additional billions in collateral immediately. The company didn't have the cash. It couldn't borrow it. There was nowhere left to turn, except the government. Here's where the second dark revelation emerges, the one that explains why AIG's bailout was different from every other rescue in the financial crisis. Because the government wasn't really saving AIG. It was saving AIG's counterparties, the banks and financial institutions that had bought credit default swaps from the company. If AIG collapsed, Goldman Sachs faced $13 billion in losses. Société Générale faced $12 billion. Deutsche Bank, Merrill Lynch, UBS. Every major player on Wall Street had exposure. More disturbing still, many of these banks had been intimately involved in creating the toxic securities that AIG had insured. They had originated the mortgages, packaged them into CDOS, gotten them rated AAA, and then bought insurance from AIG to protect themselves when the whole scheme collapsed. They had, in effect, built a machine designed to transfer risk to someone else. And that someone was AIG, backed ultimately by American taxpayers. On September 16, 2008, the Federal Reserve stepped in with an $85 billion emergency loan to AIG. In exchange, the government took a 79.9% ownership stake in the company. It was the largest corporate bailout in American history at the time. But $85 billion wasn't enough. The collateral calls kept coming. The assets kept declining in value. By November, the government had to restructure the deal and pump in another $40 billion. By March of 2009, the total had climbed to $185 billion. The American people, most of whom had never heard of credit default swaps, or AIGFP, now owned an insurance company that had gambled away its future and lost. But the darkest chapter was still to come. In the weeks after the bailout, as AIG survived on government life support, its financial products division prepared to pay out hundreds of millions of dollars in retention bonuses to the very traders who had created the crisis. $165 million in bonuses, to be exact, including millions to executives who had left the company. The contracts had been signed before the collapse, AIG claimed, and were legally binding. When news of the bonuses leaked in March of 2009, public outrage exploded. Here was a company that had been saved from oblivion with taxpayer money, now rewarding the architects of its own destruction with millions in bonuses. The optics were so toxic that some employees received death threats. Congress held angry hearings. President Obama called the bonuses an outrage. But the money was paid anyway, because in the cold logic of corporate law and contractual obligation, it didn't matter that the company had failed, that the economy had collapsed, that millions of Americans had lost their jobs and homes. The contracts were valid, and the bonuses were paid. Perhaps the most disturbing aspect of the AIG bailout was what happened next, or rather, what didn't happen. The government used AIG as a conduit to make whole the very banks that had created the toxic securities in the first place. Goldman Sachs received $12.9 billion through AIG. Société Générale got $11.9 billion. Deutsche Bank, Merrill Lynch, and others received billions more. These payments weren't negotiated down. The banks received 100 cents on the dollar for securities that were plummeting in value. The man overseeing this process was Timothy Geithner, president of the New York Federal Reserve at the time. Geithner's chief of staff had previously worked at Goldman Sachs. His successor as Treasury Secretary would be a former Goldman executive. The revolving door between Wall Street and Washington had never spun more visibly or more lucratively. In the years that followed, as the American economy slowly recovered from the worst financial crisis since the Great Depression, AIG became a symbol of everything wrong with modern capitalism. The company eventually repaid the government bailout, a fact its executives never tired of mentioning. The Treasury even made a small profit on its investment when all was said and done. But the real cost of AIG's collapse couldn't be measured in dollars alone. Millions of Americans lost their jobs in the recession that followed. Retirement savings evaporated. Homes were foreclosed. Dreams died. And the psychological damage, the erosion of trust in institutions, the sense that the system was rigged for the powerful, that damage may never be fully repaired. What makes the AIG story truly chilling isn't just the scale of the fraud or the size of the bailout. It's the realization that almost no one was held accountable. Joseph Cassano, the man who ran AIGFP and sold the credit default swaps that brought down the company, never faced criminal charges. He walked away with a consulting contract worth millions. Hank Greenberg, whose leadership created the culture of opacity and risk-taking that enabled the disaster, settled civil charges and remained a billionaire. Martin Sullivan and Robert Willemstad collected millions in severance packages despite presiding over the collapse. Not a single AIG executive went to prison. The company itself paid fines and settlements, but those costs were ultimately borne by shareholders and taxpayers, never by the individuals who made the decisions. The lesson that Wall Street learned from AIG wasn't that reckless risk-taking has consequences. It was that if you make yourself indispensable enough, if you spread your bets across enough counterparties, if you become so interconnected that your failure threatens the system itself, then you won't be allowed to fail. The government will step in, taxpayers will foot the bill, and you'll walk away wealthy, perhaps slightly embarrassed, but fundamentally unscathed. This is the real dark side of modern finance, the privatization of profit and the socialization of loss. Heads, the banks win. Tails, the public loses. Today, AIG still exists as a smaller, restructured company focused on traditional insurance. The financial products division was shut down. The credit default swap business was wound down. The company's headquarters still stand in Manhattan, a monument to an empire that nearly destroyed the global economy. But the deeper machinery that enabled AIG's collapse, the regulatory gaps, the moral hazard of too big to fail institutions, the revolving door between Wall Street and Washington, that machinery is still humming along, waiting for the next crisis. Because here's the uncomfortable truth that keeps financial regulators awake at night. We never really fixed the problems that caused the AIG collapse. The Dodd-Frank Act imposed some new restrictions on derivatives trading and created oversight mechanisms. But the largest banks are bigger now than they were before the crisis. The derivatives market is more complex. The interconnections are deeper. And the next time a systemically important institution begins to fail, the government will face the same impossible choice: bail them out or risk catastrophe. AIG taught us that in modern capitalism, some institutions are simply too big, too connected, too important to be governed by normal rules of risk and reward. They exist in a protected class, sheltered from the consequences of their own actions by the implicit guarantee of government intervention. The story of AIG is ultimately a story about trust and its betrayal. For decades, the company sold a product called security, protection against the uncertainties of life, business, and fortune. People and institutions around the world trusted AIG to honor its promises, to calculate risk responsibly, to stand behind its commitments. That trust was misplaced. Behind the reassuring facade of stability and strength, AIG had built a casino, where the house was making ever larger bets with borrowed chips, convinced that it could never lose. When the bets went bad, when the losses came due, it wasn't the gamblers who paid the price. It was everyone else, the workers who lost their jobs, the homeowners who lost their houses, the taxpayers who funded the bailout, and perhaps most of all, the people who lost faith in the idea that the system itself could be trusted to function fairly. So we return to the question that opened this story. How did an insurance company become the most reckless gambler in financial history? The answer lies not in mathematical models or derivative pricing, but in the oldest and darkest of human motivations: greed, unchecked by consequences. AIG's executives understood that they could collect enormous compensation while the bets paid off, and that if those bets ever failed, someone else would absorb the losses. They understood that in a world of too big to fail institutions, moral hazard isn't a bug, it's a feature. They understood, perhaps better than anyone, that the real product they were selling wasn't insurance at all. It was the illusion of security in a system designed to protect the powerful at the expense of everyone else. And that illusion, unlike the company that sold it, has proven remarkably durable. It persists in every assurance from financial institutions that this time is different, in every regulatory promise that the system is now safe, in every politician's claim that the lessons have been learned and the reforms have worked. But those who lived through the AIG collapse know better. They know that behind the marble lobbies and the confident projections, the same machinery of risk and deception continues to operate. They know that the next crisis is always building in the shadows, waiting for its moment to emerge into the light. And when it does, when the next AIG reveals itself and threatens to pull down the entire system, we'll discover once again that the greatest lie wasn't in any financial statement or corporate press release. It was the lie we told ourselves, that we had learned from the past, that we had built something safer, that next time would be different, because in the dark heart of modern finance, nothing really changes. Only the names are different, and the numbers keep getting larger. Subscribe and listen to our next story below.